This Week in Economics on the 16th of December 2018. Beaming from WBRN Radio and on the Bostonred Network. This is a part of our continuous coverage here of the political economic regime here in the U.S. and globally. This is, of course, a microeconomics presentation. In this presentation, we'll have the latest industrial stats from the Federal Reserve, and we'll also look at several PCIs from the PMIs from the Market Organization, and where various countries are, from Japan to France to the U.S. And from NBC, we'll have the consumer part of the package, where consumers are, consumer optimism. We've talked about that. The psychology of the market, where the market actually is. As soon as we can get back to our right. Here we go. And we'll try to sum all this up. We still don't have sales figures here from the holiday shopping in the U.S., but we'll get those obviously shortly. And let's move on here with the Federal Reserve statistical release. It was released on the 14th of December 2018. Industrial production and capacity utilization. Industrial production rose 0.6% in November after moving down 0.2% in October. The index for October was previously reported to have edged up 0.1% in November. Manufacturing production was unchanged. The output of mining increased at 1.7%, and the index for utilities gained 3.3%. And we'll look at some of this industrial production. This is at 109.4 in November. Let's see, where are we? Of 2018. Now the percentage change is 0.6%. In November 17 to November 18, 3.9%. Major market groups here. If we look at final products at 103.7, consumer goods at, this is for November incidentally of 2008, 106.2, business equipment 102.9, non-industrial supplies at 106.7 temps, construction at 113.3, and materials at 114.9. And if we look at materials from November 17 to November 18, 6.1, there was a percentage change. And we go to consumer goods, was 1.5, business equipment 4.1, November to November. Now, if we look at groups within the manufacturing sector, mining at, this is in June of 2018, mining was at 104. And in October is 105.4 for mining. Utilities in November was 107.8. And if we start looking at the percentage changes here for November, for mining 1.7 temps, for utilities 3.3, and November to November mining was at 13.2. And utilities at 4.3. Those are percentage changes. And let's move down this some here. Manufacturing. Now this is from 1972 to 2017 was at 78.3, and In 88, it was at 85.6. That was a high. The low was 77.3. In 94, it was 84.6. In 2009, that was in the heart of the depression. It was 63.7. In November, it had moved up to 75.3. And in November of this year, it is at 75.7. So the growth from November to November was, this is for manufacturing, at 1.3%. Now let's go down here. 109.4% was the 2012 average. Total industrial production was at, we're redoing some of these numbers here, at 3.9% higher in November than a year earlier. Capacity utilization for the industrial sector rose 0.4% in November to 78.5%, a rate that is 1.3% below the long run. And now this was 1972 to 2007. Market groups were mixed results. The index for consumer goods edged up nearly 2%. For consumer energy products, it was mostly offset by losses of a 0.5 percentage point. If you notice that the tank, gasoline or petrol prices have been going down. The index for business equipment moved down about 0.25%, and the index for defense and space equipment was unchanged. Amongst industrial supplies, the output of construction supplies declined 1.4% in November, while the index for business supplies rose a 0.5 percentage point. The output of industrials moved up more than 1% in gain in durable and non-durable and energy materials. Manufacturing output was unchanged in November as an increase of 0.2% for durable manufacturing was offset by a decrease of 0.2 and 0.9% for non-durable manufacturing. Other manufacturing, publishing and logging, don't ask me why, with durable goods manufacturing primary metals posted a gain of 2.5%. No other industrial group recorded a gain of more than a 0.5 percentage point. Several lost. Mining output advanced 1.7 in November, with gains in oil gas extraction, coal mining, and support activities for mines. The index for mining was at 13.2, above its level a year earlier. Output of utilities rose 3.3% in November, with an increase in both electric and gas utilities. Natural gas distribution rose sharply in both October and November, and unseasonably cold winter supported demand for heating. Capacity utilization for manufacturers edged down in November to 75.7%. That's about 2.5% below the long run average, and slightly a rise for durable goods was outweighed by decline in non-durable goods, other manufacturing, publishing, and logging. The utilization rate for mines increased to 74.1% and remains above the long-run average of 87%. The operating rate for utilities moved up to 79.4%. A rate is about 6 percentage points below the long run. So some of the things here: the Federal Reserve plans to issue its annual revision to the index of industrial production and related capacity matters at the end of the first quarter 2019. They note here, and we'll append this with the graphics and what have you, where you'll be able to see these. And I think we went over, let me just get food and tobacco in here. Some of these we did not go over as much. Food and tobacco at 9.65. That was in 2017. And fourth quarter to fourth quarter, food and tobacco In 2015 was at 1.7 and 0.2 in 16, and in 13 3.2. In 18 at the first quarter at 5, and the third quarter at 1.7. And if we go to November, a negative 0.4 there, and basically changed from November to November. This is for food and tobacco, was at a 1. For clothing, the change was negative 3.5. Clothing has been going down for a very long time. And 0.7 for chemicals. Paper products at negative 4.0. Energy at 3.1. Transportation, now this is from November to November. Transportation, business equipment at 4.1. Transportation at 3.7, industrial and others at 3.5. Wait a minute, excuse me. Yeah, 3.5, and defense and space equipment at 5.2. And let me see. We will get to motor vehicles and parts from November to November. 3.4 was there, and we go to transportation equipment, 2.8. Now this is the average from November to November. And furniture and related products at 2.3. Computer and electronic products at 5.1. Evidently, pretty good season there. In November to November, electrical equipment and appliance and components at 3.2. So there were some things here, a little more than others. Printing and support was a negative 1.8. Petroleum and coal products a negative 2.1. That was November to November. Plastics and rubber products, don't see this very much, at 1.5 in the negative there. And we won't go over, we've done computers once, so actually this is computer and peripheral equipment. And a relatively good year, 4.4 there, and communications equipment 3.7. That would be November to November. Motor vehicles 6.3, and motor vehicle parts at 2.5 November to November. Business equipment at 3.3, construction equipment at 1.2. Business supplies at a negative 1.2 there. And let me go down this. Well, autos we will do. We're at, let's see. The total of autos November of 2018 at 11.28 for autos, 2.17. That's why you see the layoffs. And trucks at 8.57. And light and heavy at 8.22. Some of the things that we see here, and we will get to capacity utilization here. We looked at most of these figures, but for motor vehicles and parts in November it was 76.7, which is fairly good. If we look back over here in 1972, it was 82.22. We want to go back there. You can look at it. And a lot of historical figures. You can look at these. It will give you an insight on what's going on if you wish to track from the 70s to the 90s and see exactly where we are now. Let's switch gears here and keep this in some order here. We'll do the PMIs here, and we'll see which PMI do we have up first. This is where we'll go ahead and do the Nikkei. The flash Nikkei PMI increased to 52.4 in December from 52.2 in November. New orders growth accelerates despite export decline to the sharpest extent in 2 years. Business conditions dropped to 7th straight month since October 2016. Today is the latest public release of the Nikkei Flash Japan Manufacturing Purchases Manager Index, published on a monthly basis here. The estimate is typically based on 85 to 90% of the total PMI survey respondents. And basically, to summarize it up, the PMI increased faster rate, output increased faster rate, new orders increased at a faster rate, exports decreased, and employment increased slower rate, backlog of work increased faster rate, output prices increased slower rate, input prices increased slower rate, stocks of purchases decreased slower rate there, and stock of finished goods increased a change of direction. And we'll get a little bit of commentary here from Joe Hayes, an economist at IHS Markit. Preliminary data shows that Japan's manufacturing sector closed in 2008 with a strong finish. Production expanded a solid in December and at the fastest rate since April. These appear to no longer impact on the output for strong contraction in the capex spending during Q3. The case for a year-end rebound in GDP looks strong based on the PMI data thus far in Q4. And we will see here how all of this goes. And here we go. To the U.S., private sector output expanded its weakest pace since 2017. This is in the U.S. The Flash U.S. Composite Output Index at 53.6. It was 54.7 in November, a 19-month low. A Flash U.S. Service Business Activity Index of 53.4. Again, an 11-month low. It was 54.7 in November. Flash U.S. Manufacturing PMI at 53.9. It was 55.3 in November. That is a 13-month low. And the U.S. Manufacturing Output Index at 54.3. It was 54. Unchanged. U.S. private sector output continues to increase at a solid pace in December, but a slowdown in the service economy contributed to the weakest overall growth for a year and a half. The latest survey also reveals a softer improvement in new orders book and a further moderation in the rate of private sector job creation. The seasonal adjusted IHS Market Flash Composite PMI output dropped from 54.7 in November to 53.6 in December, to signal a weak expansion of private sector output since May of 2017. Production growth was offset by a slowdown in the service sector to its weakest in 11 months. Some survey respondents reported that heightened economic uncertainty and concern about near-term business outlook had contributed to more cautious spending amongst clients, and as a result, the latest data points to another slowdown in new business growth, with the pace of expansion the weakest since April of 2017. Soft new order growth helped to alleviate pressure on operating capacity. This was highlighted by a stabilization on finished work in private sector firms in December, which ended a 17-month period of backlog accumulation. Meanwhile, staff recruitment lost momentum in the latest survey. The overall rate of public sector job creation was the least marked since June of 2017. The lower oil-related costs contributed to the slowest rate of input price inflation since the start of the year. Manufacturers continue to report a much faster input cost inflation to their service sector companies, which was linked to stretched supply chain capacity and the impact of tariffs on raw materials. First time we heard the word tariff in here. The private sector firms remain optimistic about their prospects for business activity over the next 12 months. However, the degree of positive sentiment dropped markedly in December to the weakest period since June of 2016. Some survey respondents cite concerns that a soft patch for global economy has the potential to hold back client spending during the year ahead. The IHS market U.S. service PMI was at 53.4 in December, down from 54.7. The service PMI, I think we gave that before, it was the lowest since January, signaling a relatively subdued rate of output growth in the service economy. Moreover, the latest data signaled a further slowdown in new business growth at the service sector. New work rose at the weakest point since May of 2017. Service providers, meanwhile, indicated that rising pay pressures contributed to pushing up their operating expense in December. However, the latest rise in the average cost burden was the slowest for 1 year. Manufacturing production volume increased solidly in December, with the rate of expansion unchanged since the previous month. These were nonetheless the signs that the near-term outlook has become less favorable, as highlighted by the slowdown in new order growth. And this is something we watch very, very closely. The IHS market flash manufacturers PMI. Now, we just finished the Federal Reserve. Registered at 53.9 in December, down 55.3 in November, to signal the weakest overall improvement in operating conditions since November of 2017. The fall in PMI mainly reflected weak contributions from new orders, employment growth at the end of the year. The rest of manufacturing job creation was soft since since April of 2017. More cautious staff hiring policies were partly due to a drop in business optimism to its lowest in 26 months. So that's roughly a little over 2 years. Now to the commentary from Dr. Williamson. As usual, the flash PMI brings signs of a U.S. economy ending in 2018 on a slower note, with business activity expanding at a slower rate for 1.5 years. The survey indicates that the pace of economic growth has faded to 2.2% in December, closer to 2.5% for Q4. Importantly, although the growth remains relatively robust, momentum is being lost and is likely to continue to fade as we move into 2019. And new orders flow hit the lowest since April of last year. And expectations regarding future business growth have slipped to the lowest for 2.5 years. Survey revealed a greater caution in relation to spending and uncertainty about the economy outlook. The weakest price of the current and future business growth has curbed appetite for hiring. Job growth inched down to its lowest in 1.5 years, consistent with non-farm payroll rising in December by 180,000 jobs. The pressure has meanwhile cooled as low prices feed through, yet rising tariffs remain a concern for many companies. Let me just go back here to market a press release here. Market predicts a slowdown in global economy in 2019. Global economic growth will edge down to 3% in 2019 from 3.2 in 2018. That's according to the annual top 10 economic predictions released by the business provider IHS Markit. While global growth will continue to decelerate, the economy will also become increasingly vulnerable to shocks. Policy mistakes remain the highest threat to global growth in 2019 and beyond. That's from an economist there, Norman B. Schuber. Anyway, simmering trade contributions are dangerous, not because they have done damage so far. They have not, but because they could easily escalate. At the same time, the sell-off in equities and commodity market, on top of the gradual removal of stimulus by some central banks, means the financial conditions worldwide are tightening. The good news is that the probability of a single policy event seriously hurting the global economy is in 2019 is relatively low. The U.S. economy is expected to grow at a rate of 2.6% in 19, less than the 2.9 seen in 2018, which in itself, for a modern industrial economy in the latter 2000s after the Depression in 2009 is basically pretty good growth. If you can get 2.5%, you are in a pretty good shape. The problem is when you rise above 2.5, say 2.9 or 3%, is it sustainable? The answer to that is normally no. And that is part of the problem here. You get 5% or even perhaps 4%. You're going to have a drop, and the drop itself can have severe impact on the psychology of the market. ISH Markit predicts European economic expansion will slow even further, declining to 1.5% in 2019. Several adversary economic and political factors are behind it. The negative impact of trade tensions on the manufacturing sector, exports, and appreciation of the euro against currencies except the dollar. The political risk has also increased significantly, contributing to a 4-year low in business sentiment. Last but by no means continued turmoil over Brexit. The UK growth, which will fall from a 1.3 in 2018 to 1.1 in 2019. Other top 10 that they list here, the Japanese recovery we just talked about remains weak, expanding at a rate of 0.9 in 2019 after growing 0.8 in 2018. A slowdown in China's economy, fallout from trade tension between the U.S. and China, the expected rise in construction spending ahead of the 2020 Olympics will sustain growth in 2019, but the boost will fade by the end of the year. China's economy will keep decelerating, lowering to 6.3 in 19. However, in response to ultra-high debt levels, the impact of U.S. tariffs on China growth policymakers have unleashed a series of monetary and fiscal measures to help support growth and stabilize the markets. They've done basically a good job of doing that. Growth in emerging markets have plateaued and will retreat in 2019 to 4.6%, feeling the effects of slower growth in the advanced economies. World trade, tightening global financial conditions, the strong dollar, and rising political uncertainty in Brazil and in Mexico, I would say in Brazil. But anyway, the volatility in commodities market will continue. Needlessly, demand growth next year will look strong enough to provide markets with support, and having the kind of price collapse and making the kind of price collapse in 2015 unlikely. Market predicts the commodity price at the end of 19 will be on par with current levels. We'll see. Inflation will not rise much. Well, inflation will not rise much if prices stay down. The Federal Reserve will stay the course by raising interest rates only gradually, likely a hike, of course, in December, a few days here. Free interest rates increase in 219 and 220. The Bank of Canada and England, the Brexit situation there. A few emerging markets, central banks may raise their interest rates. The U.S. dollar will remain strong against most currencies. Expect the greenback to hold the current elevated level of much of 2017. And for complete predictions, contact somebody there, and we'll just append this on, and you will have it. Now to the U.S. Economic optimism plunges, yet consumers still plan to spend big during the holidays. The percentage of Americans viewing the economy as excellent or good dropped to 8 points to 50%. That's according to the NBC all-americaeconomicsurvey. Those believing the economy will improve dropped 5 points to 31%. The average hour holiday spending rose to $1,100 for the first time in the holiday survey. Have seen averages below $1,000. The poll was of 802 Americans, the third through December. Economic optimism took a sharp turn in the fourth quarter with this CNBC All-American Economic Survey. The percentage of Americans viewing the economy, we already went over this. The decline wipes out a big part of the gains that ensued after DJ Trump took office. This is not a trend we have been seeing, and this is from Michael Roberts, a partner with Public Opinion Strategies and the Republican poster for CNBC. Views on DJ Trump reflect economic approval, which ticked down from 51 to 48% in most recent surveys, while his disapproval rate rose to 42 from 38. The president is repeatedly taking credit for the economy. That's Jay Bell. He's a partner at Hart Research, the Democratic poster, but now he's finding it works both ways. Well, no doubt about that as things fall apart. Amongst those saying they would spend more this holiday season, 53% said it was because of higher income and pay, and just 9% said it was due to the economy being in good shape, and fewer attribute their spending to tax cuts, lower gas prices. This is not good news. Gains in the market, at least some optimism. Decline is connected to the recent fall off, the stock market. Although Americans generally do not tie their spending to equities, loss, or gains. More to salaries, and in addition, the optimism, which has fallen from record levels prior to 2 quarters, remains high and on par with last year's holiday season. 50% of the public rating the economy as good or excellent for the fourth highest in the survey's history. Let's get a little bit here. If we can, we'll see. We're trying to get a little audio here. I'm not certain if we will get this audio. Sometimes we do, sometimes we don't. One of those things. We will append this survey anyway. Whether or not we get the audio or not. We actually do this live, so there's sometimes some snafus here as we try to get this up. A judge in Fort Worth, Texas, has struck down the Affordable Care Act known as Obamacare. Now, we have not looked at the economic consequences of this because we were in the last day. That was on Friday. We've now went past Friday. That was a deadline for getting insurance from the marketplace. from the federal marketplace. We'll see. But there will be a contentious fight around that particular item next year, and I think
viewers at home should be prepared to go through the full range of emotions from this survey: optimism and pessimism, happiness and sadness. Let's get to the data. The 12th year in a row we've done this. This is our holiday survey. Economic optimism plunging. We were at record levels in October. 48% of the public was optimistic now and optimistic for the future. This is the single biggest quarterly decline we have seen in optimism in our survey in the 12 years we've been doing this. Go back, it's now 39%. Go back to the beginning of the Trump presidency where it was just 20%. So we've held on to a lot of the gains, but gave up a bunch of it in this quarter here. And the percentage of Americans saying they are pessimistic now and pessimistic for the future ticking up and taking out that low from December 2016. Now, let's look at why that is. Expectations for gains in home values decline, for gains in wages decline, and the percentage of Americans saying it's a good time to invest also decline. So those three economic factors that we track quarter to quarter, all three of those pillars of economic confidence did go down in terms of gains that are expected. This knocked on, it reflected on the president's economic approval rating. He had been at 51% for 2 quarters running. Now he's down below that to 48%. 800 American polls around the country, margin of error 3.5%. So that's just right inside that margin of error. But you can see here also the disapproval on the economy went up from 38 to 42%. But it had no effect at all on his overall presidential approval rating. That remained right at 41%, just about where he has been his entire presidency. At the same time, holiday spending plans surged. We've never seen numbers like this. First time in 12 years over $1,000, all the way up to $1,100 compared to the forecast last year of $900. And you can see what's inside that. Take a look. Why? Well, because currently people are saying they're going to spend more because they have more income. So the difference between the beginning of this thing where we talked about the outlook, it's about the outlook for those things. But what's in people's pockets right now, that seems to be motivating them to spend. And one nice little thing here, the spending spree Americans are about to embark upon looks to be bipartisan. When we went from 16 to 17, all of the optimism about more spending was among Republicans, where 69% were going to spend more. But now look here. It's both Republican and Democrat, where both plan to go out and spend with some abandon, Becky, this holiday season.
Hey, Steve, when you look at that, the real numbers of what people are planning on spending versus optimism or lack of optimism, does it really matter and when it comes to consumer confidence on these issues or not? Or is it really what they're doing, not what they're saying?
First of all, from an economic standpoint, it matters what they're doing rather than what they're saying. There is some correlation. The less optimistic you are about the economy, the less you're going to spend, and vice versa. However, we have seen situations, and the greatest example of that, Becky, if you can remember back in the post-9/11 period where confidence in America absolutely plunged, what happened to car sales? They absolutely surged. So we have situations where you can have these declines in confidence. It could be a fright from the decline in the stock market. It could be some of the headlines we've seen now, and the political headlines could be knocking confidence off. I will say, though, that Republicans are more equally confident. The decline in confidence looks to be more among the independents and Democrats here.
All right, that was their survey from what we were able to see there, and we'll append the entire survey. Let me just roll back through here. Again, the judge in Fort Worth, Texas, ruled that the Affordable Care Act was unconstitutional because of the mandates. That was Judge O'Connor. We'll have a special program on that from WBRN Radio. Now, to Brexit here very quickly, this is from Bloomberg. A new Brexit reform gains traction to end the gridlock that is there now and around the Prime Minister, May, the Tory Prime Minister. And one of the solutions would be for people to vote on either May's deal, the Prime Minister's deal, or no Brexit deal at all. We don't know how that would turn out. Very, very difficult to say. And we've already talked about emerging markets expect pain in 2018. This is from Bloomberg. And the Singapore-based Societe Generale, one of the few to anticipate a slump in emerging markets, began in January. And looking at some of the currencies here, September led by Turkey, Brazil, in South Africa. Rand is a temporary slowdowns there. But anyway, on emerging markets, we won't spend a lot of time there. Watch out for the Fed. Time to drive emerging market assets would be when the Fed starts to cut rates, and it would be 18 months away. They will be increasing rates, not cutting rates. And with China, there is no deal there. The strong dollar is another factor that they have to deal with. So there are many headwinds here. And the small caps, I was looking at small caps, have endured the blunt of the selling in the latest market decline, largely due to their higher sensitivity to rising interest rates. The Russell 200 index is close to is on its heel with 19% fall from its record high. And this is the Russell 200. Boeing, incidentally, is opening its first 737 plant in China, where they plan to expand their production of aircrafts there in China. They're investing $33 million to take a majority stake. This is in a Chinese company. And let's see, we had the numbers here. Their aim is eventually to deliver a target of 100 planes a year at Shenzhen in China. And that'll take some of the pressure off their production plant in the Seattle area, so they can boost the sales of their best-selling 737 narrow-body situation. Let's go to the BBC and we'll do the numbers here. Well, let's see. Oh, some news here. Asbestos at Johnson & Johnson's hit their shares. Evidently, they knew about the cancer-causing problems with their talcum powder for many, many years. Reuters has a very good documentary. Invite you to look at it. Since 1971. And investors reacted, wiping 10% of the firm's market value at one point, making it the biggest loser on Wall Street. And in July, Johnson & Johnson was ordered to pay $4.7 billion to women that were affected by their product. So now let's get the market news here. We'll start with the UK. The FTSE 100 was down 0.47%. In Amsterdam, they were down 0.34% there in the negative. In Paris, down 0.88%. And in Frankfurt, the DAX was down 0.54%. The Eurostas 50 is down 0.63%. In Madrid, they were down 0.45%. And quickly to Asia, to Bombay, they were actually up 0.9%. The Hang Seng was down 1.62%. The Nikkei down 2 tenths there at the Nikkei. Back up a little bit here. U.S. markets, the Dow was down 2.2%, and the Nasdaq down 2.26%. And in Chicago, they were down negative 1.91%. Brent crude futures were down 1.90, and the West Texas crude was down 2.62. They would be resting at Brent crude at $60.28. That is a negative 1.17 change there, and West Texas crude at $51.20. T-Boone Pickens still jumping for joy. He remembers $15 barrel oil, which if we look at those multiples, we aren't there yet, but closing in. The Forex gold was down 0.43 at $1,239.15. That was on the Forex, and let's see. Well, we'll leave it at that. And we don't have, get over to Bloomberg so we can look at the commodity index. We usually use their commodities index. You got to skip around these days. The Bloomberg commodity index, the change there was 2.59 and a negative 2.59. In other words, the high was 170.97, the low 158.92. That's the commodity index. And the UBS Bloomberg, it was off 7.07% there. The Rogers Jeffers 2.28% there for them, and the Rogers International negative 34.52. And I think we got the energy. Yeah, we got them. The gasoline index down 4.39. Natural gas down 0.30. Home heating oil down 3.12. And this is a heating season, incidentally. We got gold. Gold on the spot was down $2.97 at $1,239.02. Silver was down 22 cents at $14.54. Copper was down 0.42. There were some people stealing copper in West Virginia out of an abandoned mine. Anyway, told you a little bit about what was going on. Corn was up 50 cents. And what else do we have? Cocoa was down 13 cents. Cotton, we don't look at it much anymore, was up, 19 cents. Live cattle, no pork bellies here, down 45 cents. Live cattle, always try to find our pork bellies. We've, I don't know why we're so interested in pork bellies. That was a Christmas movie. Eddie Murray had pork bellies there, one of the big things at one time. But, we were just looking this up, and we go to Bloomberg here. Pork bellies are cut. Well, let's see. This is when they had a one-year high of 1,600, and I think we'll have to go someplace else. Pork belly futures. Maybe this is it. Nothing. I've looked at this before from pork belly futures. It's closed. No update for us. Wait a minute. We got to have somewhere here. Well, what we see, they're below $70. Our pork bellies, below at 66.90. Our pork bellies, the average on pork bellies. So that's, I guess that's the best we're going to do on December the 3rd. 66.90. Anyway, with pork bellies, this will do it for us. Have a good week, everyone. For those in business, make it a productive week. And the consumer, evidently, you've kept your eyes on the prize. Only you're buying a little bit more this year. Kind of interesting there. Sort of an interesting anecdotal note. An old trader once told me that in holiday seasons that people spurge or buy more. Sort of watch out, because sometimes that will foreshadow hard times coming. I believe, if my history doesn't fail me, that this would have been the roaring 20s before we went into the 30s and went finally into the Depression. People were buying more. Just a little note. Have a good week. Good day from WBRN Radio and our partner, Transcend Analytics, and the Bostonred.org, which is the Bostonred Network.